This episode is powered by Stock Kaka, the trading sidekick, with more insights than a Wall Street analyst and enough bite to puncture even the thickest earnings report. Want to know how the pros are navigating government shutdown chaos and AI infrastructure euphoria? Pay your visit at stockkaka.my.canva.site, because while politicians play deadlock, smart money flows.
Welcome back to the Deep Dive. Glad you could join us. It's the week starting Monday, October 13th. And honestly, it feels like we're navigating a full-blown market circus out there. Yeah, circuses feels about right. The sources we've combed through this week, research notes, geopolitical briefings, credit alerts, they all point to, well, a convergence.
Three main rings to this circus, it seems.
Exactly. Three big sources of volatility hitting all at once, and the only common thread. Just massive, fast-moving uncertainty.
Okay, let's break down this chaos stack. First up, the government shutdown is now on day 12.
And that means 750,000 federal workers are really on edge about potential layoffs.
Those sources do confirm military pay is safe for now. Trump's using Pentagon funds, apparently. A small but necessary detail amid the human cost here.
Right. Then event number two. That sudden, pretty violent drop in the S&P 500 on Friday.
Yeah, that flash crash. It knocked nearly 3% off the recent all-time high. Where are we sitting now?
Dancing around 6,630. So quite precarious. It felt like a technical break driven by, global jitters.
And the third event, sounds like crypto got a serious wake-up call.
Oh, absolutely. Bitcoin served up a huge reality check. We saw something like 1.5 million leveraged crypto accounts get liquidated.
Liquidated? Wow. What did that do to the price?
Well, reports suggest prices plunged from that incredible $124,000 level down closer to $100,000. That scale of drop screams over-leveraging, just pure speculation getting wiped out.
So our job today, our deep dive mission, is to make sense of this mess for you.
Yeah, figure out what really matters, what signals to trust when, frankly, half the usual financial signposts are missing.
Which leads us straight into our first big theme. This data blackout and how the Fed is essentially flying blind.
We're 12 days into what one source called the government's tea time. A bit dry, but accurate. And the big fallout. A data apocalypse.
And we really need to underline this for you. The absolutely critical economic numbers, the CPI inflation data, the monthly jobs report, they are delayed indefinitely.
Right. The people who compile this data, they're furloughed. So the Federal Reserve, the body setting interest rates that affect everything, they're missing their main instruments.
So if the hard data is gone, what are markets even looking at? What are these scraps of info we're suddenly treating like gold?
There are basically two things left standing. First, the Fed Beige Book, which comes out midweek.
Okay, explain that. It's not hard data, is it?
No, not at all. It's more like anecdotes. Sentiment reports gathered by the 12 regional Fed banks. Usually it's just background color. But now, in this data vacuum, everyone's going to treat this regional Fed gossip like it's gospel, trying to read the tea leaves on the economy, and crucially, what the Fed might do next with rates.
And we do get one tiny piece of actual employment data, right? Initial jobless claims on Thursday.
That's it. The lone survivor on the employment front. And the forecasts are already a bit grim. Economists are expecting claims to jump to maybe 235,000.
Up from 218,000 the week before.
Exactly. Which suggests, the shutdown's ripple effects. Maybe contractors laying people off might already be showing up.
But the real nail-biter this week has to be Fed Chair Powell's speech. That's Tuesday at the IF meeting.
Correct. The Institute of International Finance annual meeting. And that's the million-dollar or trillion-dollar question. How does he talk policy when his dashboard is dark?
What can he even say?
He has to sound confident, project some kind of path forward, but also admit he doesn't have the usual numbers. Markets will be hanging on every single word, every pause, looking for any hint. Is the hiking cycle really over? Or does inflation risk still trump the lack of data? It's high-stakes public communication.
Okay, so while DC is tied in knots, the global stage delivered the real jolt. The catalyst for Friday's sell-off. China's nuclear option.
Yes, this is vital. That Friday crash wasn't just shut down nerves. The trigger was Beijing announcing these sweeping, pretty aggressive export controls. We're talking rare earth elements and critical semiconductors.
This sounds like more than just tariffs.
Oh, much more. This isn't trade war theater anymore. It's closer to economic warfare. They're restricting the flow of essential materials.
And they were specific, weren't they? Targeting 14-nanometer chips and smaller. Why those?
Because that hits the heart of current advanced tech. Those smaller 14-nanometer and below chips, they're crucial for AI, for high-performance computing, for military tech. By slapping licensing requirements on these and the gear needed to make them, China's tightening its grip on the global tech supply chain.
And the reaction was immediate.
Instant panic in Europe. Think about Germany's auto giants, VW, Porsche, Audi. They rely heavily on these components. And the source material is pretty clear. When Trump responded with a threat of 100% retaliatory tariffs, that's what tipped the markets over into the flash crash.
Let's unpack that crash a bit. You mentioned a technical term, black marubozu.
Right. For traders listening, you'll know this. But simply put, the S&P 500 opened Friday near its high point for the day, and then sold off relentlessly to close right at the session's low. No bounce, just straight down.
That sounds bad. Like pure selling pressure.
Maximum selling pressure. It signals intense conviction from sellers, basically from the opening bell to the close.
How often does something like that happen?
It's extremely rare, especially in context. The sources highlight that this specific setup, hitting a new all-time high, then crashing over 3% with a black marubozu, has only happened 7 times since 1985.
7 times? Wow. What does it usually signal?
Historically, it signals a powerful, possibly institutional belief that the immediate uptrend is broken, for now at least.
And layered on top of this economic move, there were those strange reports about President Xi's health.
Yeah, unverified rumors about a potential stroke. Whether there's any truth to it or not, it just injects another layer of massive uncertainty right when China's making these really aggressive moves. Yeah. A leadership question mark on top of policy aggression.
Right. Okay, moving to our third theme. How did other assets react to all this turmoil? Where did money try to hide? Gold.
Gold did what gold is supposed to do. It barely flinched, held steady near $3,900. In times of geopolitical stress and government dysfunction, that physical safe haven appeal kicks in.
So gold held its ground. What about Bitcoin after that liquidation cascade?
Well, Bitcoin showed the other side of the coin, the danger of leverage. Yes, the price, even around $110,000, is still up a huge 77% year over year. But that brutal drop, potentially near $100, just incinerated speculative bets.
So the euphoria has been dampened a bit.
Definitely checked. You see it in the prediction markets, too. They're giving, what, 63% odds?
Yeah.
That Bitcoin stays below $116,000 this week? More cautious now.
Okay, let's bring it back to the S&P 500. We closed Friday around 6,630. You called it precarious. What are the key levels you're watching?
That 6,630 level itself is significant. It's sitting right on key put support, according to the analysis.
Meaning options traders have bets clustered there.
Exactly. But the real line in the sand is lower, around 6,550. Below that, you enter what quants call super negative gamma territory.
Okay, translate super negative gamma for us.
Think of it like an avalanche. Once selling pushes the market below that 6,550 level, options dealers are forced to sell S&P futures aggressively to hedge their own positions. This selling then forces the market lower, which forces more hedging and so on. Selling begets more selling.
A downward spiral. What's the potential target?
Often these moves target the next big area of institutional support, which looks like it's around 6,400.
Despite all this drama, the VIX, the fear index, only spiked to 21.66. That doesn't sound like outright panic.
It's definitely elevated. You could call it annoyed or concerned territory. True terrified market panic usually kicks in when the VIX gets above 25, maybe even 30. So, yes, anxiety's high, but the institutions haven't completely capitulated. Not yet.
Interesting. Now, let's look under the hood. There's this huge narrative around AI infrastructure build-out, but it seems to be hitting a snag.
Precisely. You have this incredible demand story. Look at Oracle reporting a massive $455 billion cloud backlog. The AI dream is huge. But this week also gave us the first real major crack in the private credit market.
Which was?
The bankruptcy of a company called Tricolor. They were an auto lender, specifically lending to, well, less qualified borrowers.
Okay, an auto lender goes bust. Why is that a big signal for AI?
Because of how Tricolor was funded. It relied heavily on private credit firms, these non-bank lenders that have ballooned since the 2008 crisis. Tricolor failing suggests the riskiest, most leveraged part of the debt market is starting to break. And that raises serious questions about where the money, the capital, for these giant AI projects is going to come from if credit tightens.
Are we seeing signs of stress in the bigger private credit players too?
We are. Blackstone, a giant in the space with maybe 20–25% exposure to private credit, just saw its stock price break below its 200-day moving average.
That's a classic technical warning sign, isn't it?
It is. It often indicates that large, informed investors are getting nervous, maybe anticipating trouble or lower valuations ahead in those private leveraged markets. The AI dream needs funding, and the funding source is looking shaky.
Okay, a lot of macro headwinds. Let's shift to our final theme, specific stocks to watch this week. The sources are looking for companies with, quote, actual moats plus earnings catalysts. Where should you focus?
Right, amid the noise, look for resilience and specific triggers. First, sticking with AI infrastructure, but maybe not the obvious names. Consider HPE Hewlett-Packard Enterprise.
HPE, why them?
They're being positioned as the enterprise dark horse, maybe the only significant competitor to Supermicro, SMCI, when it comes to deploying these high-performance AI server systems in large companies.
And isn't there some activist involvement there now?
Yes, Elliott Management is actively buying shares. Their stated goal is to unlock value, which is usually code for, we think this stock is undervalued, especially given its AI potential, and we're going to push for changes. Makes HPE interesting.
Okay, who else in the AI supply chain?
Micron Technology, MU, the memory goldmine. AI models are incredibly data-hungry, needing vast amounts of high-bandwidth memory, or HBM.
And Micron makes that memory.
Exactly. Demand is just exploding. Micron actually had to raise its revenue forecast recently by $500 million because even they underestimated how thirsty AI development is for their products.
Now, turning to earnings this week. Two big ones that feel like market-wide truth serum moments. Let's start with Thursday's report. Taiwan Semiconductor, TSM.
TSM, this is huge. The chip godfather's confession, as one source put it. Expectations are sky high. Earnings per share around $2.61 on revenue of $26.1 billion. That revenue number would be up 40% year over year.
40%. Why is this report so critical for everyone?
Because TSM makes the chips for almost everybody who's anybody in advanced tech, including NVIDIA. So their results and commentary will either provide concrete proof that this global AI boom is real and financially sustainable, or it'll expose potential cracks in the narrative. It's a bellwether for the entire sector.
And before TSM, on Tuesday, we get bank earnings kicking off with JP Chase, JPM.
Right, and the common wisdom is banks love chaos. JPM's results are the first big test of that thesis in this current environment.
How does chaos actually help a bank like JP Morgan?
Volatility drives trading. When you have shutdowns, trade wars, big swings in interest rates, currencies, stocks, clients need to trade more, hedge more. That generates significant revenue for the big investment banking divisions like JPM's. Their earnings will show if they capitalized on this recent turbulence.
But there's a catch, according to one source.
A quirky but noted observation. Cramer is apparently bullish on JPM heading into the report. And, well, historically, that's sometimes been a signal to brace yourself for. Let's say complexity or maybe results that aren't quite straightforward. Just something to keep in mind.
Okay. And one quick geopolitical stock sidebar. Tesla. TSLA.
Yeah, Tesla's technically vulnerable. It broke below $430 last week and is now looking down towards really critical support around the $400 mark.
What's driving that weakness?
It's caught in a crossfire. On one hand, you have optimism about its robotaxi plans here in the U.S. On the other, the escalating China trade war creates huge uncertainty around its production, sales, and regulatory standing there. That $400 level is absolutely key for TSLA sentiment this week.
All right, let's try to pull all these threads together for you, the listener. What's the big picture takeaway from this deep dive?
Well, we've got the government shutdown creating a persistent drag and data vacuum. We have China taking aggressive action on critical tech inputs. We've seen leverage blow up spectacularly in crypto, and the stock market itself is testing critical support.
The S&P sits at 6,630. Below 6,550 is that negative gamma danger zone, maybe targeting 6,400.
And underneath it all, the exciting AI build-out story is bumping up against the first serious signs of stress in the private credit markets that are supposed to help fund it. October is certainly living up to its volatile reputation.
So based on all this, what are the highest conviction ideas emerging from the source material?
The lean seems to be towards defensive growth and specific hedges. SMCI is still seen as a contrarian value play in AI hardware. NVIDIA, of course, remains its choice for those betting the momentum continues into its November earnings.
And on the hedge side?
Puts on those private credit exposed names like Blackstone, BX, and Owl Rock, OWL are mentioned. And maintaining solid positions in gold and holding dry powder, cash, seems prudent.
That Friday flash crash felt very Wall Street. Retail investors get excited, pile in near the highs. Then institutions use geopolitical news as cover to reset prices violently.
It was textbook. And remember, we've only seen this specific technical pattern, the high, then the 3% plus marubozu crash, 7 times since 1985. Historically, believe it or not, markets tend to be higher 3 to 6 months after such an event.
Which brings us to the final provocative thought for you to chew on. Given the ongoing shutdown, China's economic warfare, these cracks in private credit, is this time different? Are we set for more sequels of pain, or does that historical pattern of rebounding after the crash still hold true?
That's the key question for the weeks ahead.
Kaka signing off. When governments shut down and trade wars heat up, smart money adapts faster than a politician changing positions. Keep stops tight, powder dry, and remember, the best opportunities often emerge from the worst headlines. This October is just getting started.